Okay, so good evening. Can anyone hear me? Can you confirm if you can hear me from online? So good evening, ladies and gentlemen. And this is a webinar for February 2024. And this one will be talking about deferred tax and then the new adjustments or amendments to that IAS 12. IAS 12 is the one talking about deferred tax. So we'll be looking at that as we move on. So what are the learning outcomes? We discussed deferred tax accounting relating to assets and liability arising from a single transaction. Then we'll also be looking at the enumerate options for deferred tax on entities transaction. Then we will discuss changes to the initial recognition exception. So there are some exception before and currently now, because of the amendments, that as exemption have been removed from those items. We'll be looking at that as well. So the content, we'll be having overview of the VAT tax under IAS 12. Then we'll be looking at accounting for leases by a leasee and the decommissioning liability. I believe we know all this. Lease is talking about IFRS 16, and the decommissioner liability is talking about the IAS 37. Okay, then we also have amendment to deferred tax recognition under IAS 12, and we're looking at the transition requirements and effective dates of the change. Then we're looking at the case studies, how it occurs. So let's start with first one. It's talking about the overview of the deferred tax. So what is deferred tax? What is it all talking about? The first thing is that determine whether there is a temporary difference between the carrying amounts and of asset or liability and their tax basis. So we'll be comparing the carrying amount of assets and of the liabilities. Under assets, we can have PPE, either current asset or non-current asset. So under non-current asset, we can be having PPE, building, motor vehicles. We can be having as long as that asset can be depreciated, we can calculate depreciation on it, or we can calculate amortization, as the case may be. Then for non-current asset, we'll be talking about receivables. We're talking about what again? After receivable, we can be talking about the prepayment. Okay. Then other liabilities, we'll be talking about the non-current liability and the current liability as well, comparing it with tax basis. We'll be looking at this as we go on. Then determine whether there is an unused tax losses and unused tax credit. You know, if you have loss relief, the loss you have been carrying forward, so there's also deferred tax on that. We'll be looking at all those aspects. Then determine whether IAS 12 prohibits or restricts recognition of deferred tax on any deductible temporary difference or unused tax losses or unused tax credit. Then the fourth one, recognize deferred tax on all tax difference, temporary difference, unused tax losses, unused tax credits, not subject to such a prohibition or restriction in 3 above. Then we'll also be looking at the measurement or measure deferred tax using tax rates or legislation enacted or subjectively enacted at reporting dates, having regard to the expected manner of recovery of assets and settlement of liability and any uncertain tax treatment. Then 6th one, we'll be talking about allocate any income tax charge or credit for the period to profit or loss, other comprehensive income, OCI, or we'll be looking at all this. I just want you to know what we'll be talking about as we move on. Then after that, we can move to how do we present income tax in the financial statement as required by IAS 12, and how do we disclose? What are the disclosure? What are the requirements information that you must include when we have a transaction that involve IRS 12? The key step in computing, recording, and disclosing deferred tax under IAS 12. Let's get started. Now, the deferred tax under IAS 12 is computed using a temporary difference and a tax basis as follows. So the thing is that you always look for the carrying amount of the assets and the carrying amount of the liability. What do I mean by carrying amount? The carrying amount is the figure you have as an accountant. When accountants prepare their financial statements, they are going to have their figure on the financial statements. Those figures you see on that financial statements, probably as at 2023, December 2023, or as at year end, that is the carrying amount of those figures or of those items. But there are some probability that tax will not be agreeing with your figures. So tax will need to calculate their own figures based on the tax law, based on the tax acts that requires. So in the process of calculating their own figure, comparing to the accountant figure, that is where the difference will be coming from. And that is why they will always be carrying amounts in the aspect from the perspective of the accountant. Then there will also be figure from the perspective of who? Of the tax man. Then the difference between the two will now be giving us temporary difference, which it can be either be assets or it can either be what? Liability. Then once you are able to get the difference, then you apply the tax rates for that particular period. That tax rate, when you apply on that difference, then you get your deferred tax for that year. So we'll be looking at this as we move on. In addition, deferred tax asset may also be recognized in two other items as follows. You can have unused tax losses carry forward. You apply the deferred tax rate. You can also calculate deferred tax on unused tax credits carry forward, which will also be applied using the tax rate. Okay, because the loss you are carrying forward today, in the next future, it might be giving you the differences. So we are going to look at that as we move on. I don't want to jump the process. Okay, so from here, the next one we have, we'll be talking about how do we recognize if deferred tax is going to be temporary difference assets or it's going to be deferred tax liability. How are we going to know that this is deferred tax assets or this is deferred tax liability? So we have four scenarios, and this first scenario can possibly lead to either deferred tax asset or deferred tax liability. Let's look at the deferred tax aspect first. For scenario one, we can have deferred tax assets when the carrying amount of assets is greater than carrying amount, the tax base of assets. When you compare what an accountant has calculated as carrying amounts under their assets, either current assets or non-current assets, compared to the assets that we have in tax computation, their own balance. By the time you compare the two figures together, when the one of the accounting aspect is greater than the one of the tax aspect, then we say we have deferred tax assets. Then another scenario is when the liability of the accounting aspect is greater than the liability of, is lesser, sorry, when it's lesser than the liability of the taxman, then we also say we have deferred tax asset. We're going to be looking at scenario on this for us to understand. Then the third scenario is when the assets of the accounting or the accountant is greater than the assets of the taxman. Then we say we have deferred tax liabilities. Then when the liability of the accounting is lesser than the liability of taxman, then we also say we have deferred tax liability. Let me take that for the last time. When the assets of the accounting is lower than the asset of the tax, then we say we have assets, deferred tax asset. When the liability of the accounting is greater than the liability of the taxman, we say we have deferred tax asset. Then when the assets is greater than the asset tax base, we said we have tax liability, deferred tax liability, and the last one. Okay, so let's move on. So the tax base of an asset is the amount deductible for the tax purpose against any taxable economic benefit that will flow when the asset is fully recovered. I'm still going to explain all those items in detail. Now, if the economic benefit realization of the asset will not be taxable, the asset base equals its carrying amount. That is under the tax base. Then, under the tax base of a liability is carrying amount less any amount that will be deductible for the tax purposes in respect of the tax liability in the future. Then, in the case of revenue received in advance, the tax base of the liability is carrying amount less any amount of the revenue that will not be deductible in the future. I have scenarios to explain the deferred tax. And either you are writing ICANN this diet, or you are already a chartered accountant, you need to understand this IAS 12. And if I look at one of the difficult standards that students or people find it difficult, I think IAS 12 is part of it. We can be talking about IAS 12, we can be talking about IFRS 17, you can be talking about IFRS 16. This leases, deferred tax, and contracts. I think, and the financial instruments. I think those four standards are somehow difficult for people to understand. Okay, now let's look at it. How do we know that there is tax, there is deferred tax assets or deferred tax liability? Now, let's look at this information. A machine costs 100,000 naira with depreciation to date of 18,000. So we all know that to get our carrying amount is going to be the cost minus what? Minus depreciation. So 100,000 minus 18,000 will give us 82,000 as a carrying amount. Then we now compare the tax base. The issue that always happen in deferred tax or with tax people is that they always disallow some things that accounting has done. They will now do their whole to replace. However, this replacement will cause a temporary difference. It won't be a permanent difference. Though we have some things that they will add back completely, that it will be permanent. They will not even think of resolving it in the future. They will not reconcile it, such as fine and penalties. If you look at calculating your adjustment profit, what you normally do is that you add back your penalty and fine, because the tax person will tell you that it's none of their business that you are paying fine and penalty. You should have what? You should have obeyed the law or the instruction in order for you to what? To avoid paying that penalty. So tax people will disallow fine and penalty, and it will be permanent difference. But in this case, we are talking about temporary difference, and it is temporary difference that always cause deferred tax. That is what the account has done compared to tax people, but for just temporary. At the future date, the two will still agree and it will be zero. Okay. Now, we have calculated our carrying amount to be 82,000. Then the tax people will disallow the depreciation of 18,000. They will now calculate their own capital allowance. I think I have a question. Dr. Peter, ACA. Okay. Thank you for professional colleague. No problem. So the tax people will now disallow the depreciation that have been calculated by the accountant or by the in accounting method. They will add back their own capital allowance. So in this case now, they will be disallow 18,000. They will use 30,000 in replacement of 18,000. So which means it will be 900,000 minus 30,000, which will give us 70,000. That is how we have 70,000 for tax base and 82,000 for accounting base, which is the carrying amount. We will now compare the difference. By the time you look at the difference here is giving us 12,000. We now want to know if it is temporary difference, which is yes. The difference is just the temporary difference. By the time you calculate your depreciation for the whole year of that useful life of the asset, and the tax people also calculate their own capital allowance for the whole year of the asset, the two figure will still remain, will still result to what? To zero. The difference will be what? Will become zero. Now, how do we now know if this is an asset or what? Or liability? What do we need to do? The tax rate, the difference is 12,000. But for us to get our deferred tax, we need to apply the tax rate. And the tax rate is what? Is 30%. So 30% of 12,000 will give you 3,600. 3,600 is our deferred tax. But we need to know if it is deferred tax assets or liability. How do we know if deferred tax asset or deferred tax liability? This question, this figure you are seeing here is deferred tax liability. Is deferred tax liability because the carrying amount is greater than the tax base. And if you come back to our first slide before this, you will see when assets carrying amount is greater than the asset tax base, that is scenario 3, we'll be having deferred tax liability. Okay. Now, let me now tell you why is it deferred tax, why is it liability? The reason why is liability is that these people, let's assume their profit for this year. Let's assume their profit for this year is 100 million naira. And they calculated depreciation to be 18,000. If you remove 18,000 for accountant will have removed 18,000, which have given them that 100,000. The more the cost, the higher the cost, the higher the profit, the lower the profit you are going to get. So this profit now, by charging 18,000, they are having higher profit. They are having higher profit. They're having a lower profit because the cost is lower. They're getting just 18,000. But when tax people want to do, they will add back that 18,000. They will now deduct 30,000. And because the cost they are deducting is higher than 18,000, their profit will reduce, which means they will be paying lesser tax. By the time you apply 30% on that, they will pay lesser tax this year as a result of charging higher capital allowance. However, they are paying lower tax this year because they are having lower profit. But in the future, when you calculate and you continue to unwind that particular figure, you will be paying higher tax in the future. That is why it's deferred tax liability. It's a deferred liability you are going to pay in the future, though you are enjoying it at this moment. I don't want to overflog this because of that interesting match you want to watch. So if there's need, we can reconnect again, maybe when next, to complete it, if you are unable to complete this. Now, let's look at the next example. A trade receivable denominated in foreign currency has initial carrying value of how much? Of 80,000 naira or 80,000 naira, yes. This was translated at the year end to 75,000. The exchange loss already recognized in this profit or loss is disallowed for tax purposes until it is realized. And that is how tax people will behave. Tax people will not, they will never take provision from you. And they will never take anything called the exchange loss or exchange gain. They will disallow all this. Tax people actually deal with cash movements. So any adjustment you made that is not involve payment of cash, they will disallow it because provision is not allowed, except if it is specific provision. But anything like general provision, they will disallow it. Okay. Now, let's continue this aspect of it. Now, they said the figure now has been adjusted because as a result of exchange loss. They said the figure now is now 75,000. Then when you look at the tax base, the tax people will not agree with that. They will disallow that exchange loss and they will still maintain their 80,000 naira. The difference between the two is 5,000. Now we want to look at it. When the carrying amount is lesser than tax base, what do we have? Let's go back to that diagram and let's see what it's going to give us. When the carrying amount of assets is lower than asset of tax base, because we are talking about receivables here. So receivable is an asset, though it's a current asset, but it's still an asset. So it means this scenario 2 fall under what? Falls under, this question 2 fall under scenario 1 because the asset is lesser than the tax base and we are having 5,000. How are we going to know if it is liability or asset? This is an asset because at this time, these people are recording what? They are recording 75,000 in their own accounts. And they are also charging what? They are charging the exchange loss. But tax people will disallow it. They will assume that they've not collected that money. And as a result of this, they will be paying higher tax this year. But in the future, when tax people recognize that exchange loss or when they reduce that receivable to normal price, they will be paying lower taxes. That is why we said it is an asset in the future. They are still going to get it in the future compared to the liability that they are enjoying this year, but they are still going to pay tax on it in the nearest future. I believe I'm making sense. If you have any question as we go on of any clarity, you can drop question on the chat box or you can unmute yourself and ask your question. Okay? This okay, you have a
Hello,
question?
sir.
Hello.
Yes, thank you very much.
All
Sorry
right.
for interrupting you, class.
No
Can you
problem.
hear me, sir?
I can hear you.
Okay, thank you very much.
Yeah.
So let's assume that this exchange and this difference between the foreign currency, whatever, is an exchange gain.
Okay.
Now, are we supposed to recognize the net or the portion that relates to that particular year financials? I don't know if you get my question, sir.
Yes, loud and clear. So if
Okay,
it
thank you
is,
very much.
yeah, so if it is exchange gain or exchange loss, the accountant or accounting aspect will still recognize it, because as an accountant, we capture every cost and every gain. But tax people will still disallow it because there's no movement of cash. When do we get exchange gain? Maybe this receivable is, if okay, it's not even maybe, they have already told us. They said denominated in foreign currency. Maybe you want to receive 50 million naira from A and B in America. And because the dollar rate is increasing and falling, there's tendencies for you to have either exchange gain or exchange loss at the end of the year. Because if the amount we want to receive from A and B from America is $50, we will need to convert that $50 to our naira. And we are going to use the exchange rate at the end of the year of the reporting date. So, or when the transaction occur, it depends. Now, by the time you use that exchange rate to convert it to the foreign currency, that is the functional currency in which you are preparing your financial statement, there is possibility that it's either is going to be higher than what you have in the account before due to the exchange gain or loss, or it's going to be higher due to exchange rate. Now, whatever you do, whatever exchange, whatever you have, that will be on accounting base. But when it gets to the tax base, is either is loss or gain, they will still. Okay, so let's continue from where we stop. Okay, so what I'm saying is either is profits, either is gain or loss on that exchange gain. Accounting people will recognize it, but tax people will still disallow it because it does not involve cash movements. Okay, I hope I've been able to answer the question. Now, if it is exchange gain, it means, assuming this 5,000 is exchange gain now, it means this one will increase, it will be 85,000. And this one will be what? This one will be 80,000. And this one will not result to loss again. It will now be what? It will now be liability. Because you'll be enjoying it this year, but you are going to pay in the future. Has that been answered correctly?
Thank you, sir.
All right. So let's take the third one. A trade receivable has a carrying amount of 28,000, which means that is from the accounting aspect. Now, the corresponding revenue has already been included in taxable profit for the year and the tax rate. So it means since receivable for the year is 28 and we don't have any information that this is reduced or there is something that the accountant have adjusted for that. So it means the tax people will collect and accept that. And in a situation where the carrying amount and the tax base are equal, so it means there is no deferred tax. So everything will be just zero. Okay, that is the same scenario under that aspect. Then the next scenario is this: a provision for environmental damages in the statement of financial position is 500,000. This will only be allowed for deduction in computing current tax on payment. What we are saying here is that provision is not allowed in tax computation. Anywhere you see provision is either is general provision or specific provision. When it is general provision, tax people will disallow it. But if it is specific provision, then the tax people will accept that. But in this case, when examiner are silent, then it means it's a general provision. So accountants generally, accountant will always make provision, especially when IAS 37 is talking that when it is probable for you that you have obligation, you must what? You must make provision for it. For example, you have a your company has a cost case, sorry, and you have gone to the court, and you can see the way the case is going, and you know that, see, the probability of winning this case is 1% or is 10%, and the liability involved in this case is 50 million naira. IAS 37 says you must make the provision immediately that it is probable that you make that payment or you are liable to that. But that is accounting aspect. Tax people will never accept that. And that is why if you have that provision in accounting, when it get to the tax base, they will hand it back. And they will not recognize that carrying amount from accounting, which will lead to difference of 500,000. Now, it's going to lead to difference of what? Of 500,000. And when it's leading to difference of 500,000, are we going to be having assets or liability? How do we get this 150? You apply the tax rate. 30% of 500 will give you 150. So that is deferred tax. Now we want to determine if it is deferred tax asset or deferred tax liability. Now, if the provision is 500, okay, in this case, the tax people said no, there's no provision. So they are adding back your what? They are adding back your 500 to your tax adjusted profit. And your profit will now go up. And when your profit go up by 500, you'll be paying higher tax when they apply the 30%. But that is just for temporary. By the time you get to the future, it is now an asset to you because you are paying tax you're supposed to pay in the future today. So when you get to future, you'll be paying lesser tax, even though you are paying higher tax today. That is why it is a what? It is the liability aspect of it. Then the next one is the accrual or the accrue expenses. For the accrue expenses, we have a carrying amount of 685,000. The related expense has already been what? Deducted for tax purposes. So it means there's no difference between the tax and the carrying amount. And when there's no difference between the two, it means the deferred tax does not exist. When the two agrees, that is the accounting and the tax base agree, then no difference. Then the next one also, which is talking about the current liability, include rental income received in advance with a carrying amount of 550. The rated amount will not be taxed until realized to P or L. That is under the carrying amount and the tax basis. And you can see that the figures still remain the same thing. When the figure remain the same, there is no deferred tax in that aspect. Okay, so I still have more scenario that we'll be talking about as we move on. So let's move to the next slide. I hope we'll be able to finish this before our beloved country we start their final. Now, let's look at this aspect now. We are looking at the accounting for leases by a lessee and decommissioning liability. This is where the amendment is coming from. Before, they don't always calculate the factors on the lease and the decommissioning liability. But now, according to this adjustment, there is now accounting for that. So we'll be looking at that as we start now. Okay. Now, accounting for lease by a lessee. KJ Nigeria Limited enter into a 5-year lease of a building on 1st of January 2023. The rent for the first year on 1st of January 2023. Subsequently, annual lease payments for each year starting from the second year will be made on the last day of each year. In addition, JKY incurred initial direct cost of 5 million naira in connection with the lease. For tax purposes, the initial direct cost of 5 million naira is deductible for tax upon what? Upon payment. Also, upfront lease payment for 2023 made at least commencement date will be available for tax deduction immediately. Tax rate is 30% as the interest rate implicit in the list is not determinable. The incremental borrowing rate of GKY is 18%. JKY concludes that the tax deduction that it will receive for lease payments relate to repayment of the lease. This question is under IFRS 16 lease. So it means we are treating IAS 12, we are treating IFRS 16, and we're also treating IAS 37. Now, what is the instruction? The instruction here is this. Show the accounting entry to recognize the lease payments for 2023 made on 1st of January 2023. Show the accounting entry to recognize initial direct cost incurred. Determine the present value of future lease payments. Show the accounting entries of recognize the present value of future lease payments, and then show lease liability amortization table. Then we now compute our deferred tax if there is anything like that in the question. So let's look at it, how it's going to look like. So this is case 1. And what is case 1 talking about? The first payment they made, which is the first initial payment at the commencement date, is 20 million naira. So how do you treat that in the account as an accountant? You will debit the right use of account, the right of use of asset, and then you credit the cash that the cash is going out. Because once you pay that payment, once you make that payment, you have rights to use that asset. So it becomes the asset under you, and you recognize it as an asset, which is rights of use assets 20 million, and the cash you made 20 million naira. Then there's also commission of 5 million naira. You will also capitalize that commission. And how do you capitalize it? You will debit right of use assets with that 5 million naira, and you credit the cash that the money is coming from by 5 million naira, making total right use of assets to be 25 million naira. Okay, that is the first instruction they ask us to do. That is, how do you recognize that in your account? Now, how do you now determine the lease liability covering the remaining 4 years? Now, to calculate the lease liability is very simple. You just list the year 2023 to 2017, because they said it's going to take them 5 years. In the first year, you have already made payments, so you don't have any liability on that. Then they gave us the interest rates, which is 18%. So that 18% will be what we are going to use to discount, because that amount, which is 2024 to 2017, 2027, they are in future cash flow, and we need to discount them to present cash flow or present cash. Do you understand now? Because as an accountant, you are not expected to present your figures in future value. You need to discount them to present value and recognize them in the financial statement. And that is what we are doing here. And how do we go about that? If you have written FR, so, and you have done IFRS 16, this will be like a recap for you. If you are in a professional class and you have done IFRS 16 under CR, this will also be a recap for you. How do we go about it? Year 2, they said they are going to be making payments every year, 20 million. Then you discount this 20 million one by one. When you discount this 20 million, you will be getting 14.3. You will be getting 12 for the second year, 10 for the third year, and then 8 for the fifth year. Addition of this figure is the total lease payment you are going to pay in the future. But this future, this 45, is the present value of what's supposed to pay in the future, which you have discounted. And that is the question 3, requirement 3, that question is asking us to do. Let's go to the requirement 4. Requirement 4, what is it saying? Requirement 4 is saying that how do we now recognize this discounted figure that you just calculated now? How do we recognize it? You know, the 25 million, the 20 million, and the commission 5 million we recognize is just for the first payment. We still have 4 years to pay, and we are yet to recognize that 4 years. We will now debit rights of use asset again and credit the lease liability, because we are yet to make payment for this 45 million. We have paid the first one, and that is why we credited the bank account. But now this one will not be on our face of financial statement as liability. So we will be having right use of asset of 45 as asset plus that one, then 45 as liability. And this is where the factors will now come in. Don't forget, we will now compare the carrying amount of the asset to what tax people are going to agree. Then we also compare the liability of the lease with the tax people, and difference will not be what they are going to agree and what they will not be agree. So that is note 4. Let's go to 5 before we now look at the point we are trying to drive at. Then instruction 4 says that we should compute amortization table. And what is amortization table saying? The amortization table is saying that, see, the liability we have computed now, the present value we are going to pay, we need to now deduct it from the payment, and we discount it. So what are we going to, recognize the interest that will be charging on it. So we will start from that balance. What is the balance? The real balance is 45.5. By the time you apply 18% on 45.5, you'll be having 8.2 million naira. By the time you add interest to the opening balance, you'll be having 53 million naira. That would be the closing balance in year 3. In 2023, which is year 2. Then this closing balance will come to opening balance in 2024, and you apply the same interest rate. This question we are treating is IFRS 16. For those who are writing ICANN, this is lease. This is how to prepare lease. Okay, so apply your rates on 553, you will get 9.6. You had it again, but in 2024 now, there's going to be payment in 2024. Less that payment of 20 million, you'll be having 43 million as balance. Is the balance you are going to bring to opening in 2025. You apply rates on it again, which is 80% of this, less the payments you are going to make in future in 2025. The balance will be what? The balance will be 31. You bring that 31 again to opening in 2026. 2026, yes. Then you apply your interest rate on it, less your payments, and you get 16. Then at the end of 2027, you bring that figure here as opening, apply your tax rate, payments of 20, then your figure must be 0 at the end of the year. That is, at the end of 2017, you are going to make the full payment of that liability. I hope there's no question on that. If you have question, drop it, and you can also unmute your mic. Okay, so let's continue. What we have done so far now is the lease payment. And that is what the standard is saying. Don't forget, we are not really treating IAS 12. I only started with that scenario for me to explain what IAS 12 is talking about under deferred tax. We are only talking about the amendments. And the amendment is the lease and the commissioner liability. So we've talked about the one of lease aspect, what could happen. We are still going to talk about the deferred tax aspect of it when we move forward. But let's talk about the decommissioner liability now, which is case 2. Decommissioner liability, you are going to find that under IAS 37. Okay. On January 1st, 2023, EBC Telecoms leases a land for 10 years for the installation or telecommunication tower. Had the expiration of the lease term, EBC, I think I have a question. Please, are we getting the slides and recording, sir? Let's see how it goes first. Let's see how it goes first. Okay, so EBC estimates that it will incur 20 million to remove the tower and restore the land back to its original state. The present value of the present value of 20 million naira is capitalized as part of the cost of the telecommunication tower. The appropriate discount rate of the provision is 10% for the tax purpose. The expenditure will be deducted only when it is paid, and the tax deduction is allocated to the decommissioning liability. Why are we going to have this deferred tax here? Let me explain what it means. IAS 16 states that IAS 16 discuss about decommissioning. That is, if you, let's assume you have a plant and machinery, and you put that particular asset, maybe plant and machinery, in a particular location or community. But the agreement is that you must remove that plant and machinery after the lease period. Maybe you only lease that period, that's a land for 5 years for you to put your plant, especially for those all this network, Airtel, MTN, and the like. They mostly lease where they put their tower. And at the end of a particular year, they have to remove it. Maybe the agreement between the lessee and lessor is that when you are removing this pole, you must make sure you put this land the way you met it. And what the accountant will do is that, according to IAS 16, you have to value how much you are going to spend on that decommission, restoring that land to the normal place. If that's will cost you 20 million naira, according to IAS 16, you have to add it back. You have to add it as part of the cost of that asset. Okay. Then the second leg will go to where? It will go to liability. You will continue to carry that liability until the final day or the final year when you actually pay for that restoration, and you credit that, you debit that liability to remove it from your asset, from your account. Then you credit the bank that the money is coming from. Why the value of asset will still remain with the same thing after you have fully depreciated it. That is what the accounting people will do. But the tax people will say, see, no, you cannot start making provision today. Provision is not allowed from our own side. You can only make provision until, you can only recognize this until you make payment for this removing or restoring of the land. And this is what we call deferred tax, because the accountant will be taking this 20 million naira as a as a liability in their account. Why the tax people will reject it? They will put a zero as this discommissioner. And we'll be having the difference of what? We'll be having difference of 20 million naira. And what will be the deferred tax? If the tax rate is 30, as stated here, it will now be 30% multiplied by 20 million naira. That percentage will be your deferred tax. Now, we now need to know if it's going to be deferred tax asset or liability. The thing is that this year, they will not recognize that. That is, they will add back that 20 million naira back to their profit, making they will be paying higher tax this year. But in the future, they will be paying what? They will be paying lower taxes. Okay, and that is where we are going to come up with either is deferred tax asset or deferred tax liability. I think that one is clear. Now, the issue is now determine the fair value of the decommissioner liability, and then show the accounting entry to recognize the present value of the decommission. So we have the cost of capital to discount it, which is 10%. So we'll be using that to discount 20 million naira. And I believe we can all do that for those who are writing PM or those who are writing the SFM. So we all know how to discount. So to discount it, we will say the 20 million naira multiplied by what? Multiplied by the normal formula we use is 1 plus R. Open the two will be in bracket, then raised to power what? Minus N. So the minus N there is talking about years. And we look at the figure, we are talking about 10 years. So that's why we have minus 10. Then 1 plus rate. What is the rate in the question? The rate in the question is 10%. And that is why we are having 1.10. So 1.10 raised to power minus 10 multiplied by 20 million will give you 7.7. 7.7 is the what? Is the discounted figure. That is the future cash flow, the future payment or the future liability is 20 million, but the present value of that 20 million as of today is 7.7. So an accountant will recognize 7.7 today, and this 7.7 will be added to what? To the PPE. You will capitalize it as the cost, as part of the cost of asset. Then you will credit the decommissioning liability of what? Of 7.7. Okay, and you continue to roll it over and over. So every year you have to be recognizing that. So next year you will recognize another 7.7. Then the following year until you get to the 10th year, and the 10th year the total of the commissioning will be 20 million naira in total. Okay. How many minutes do we have now? Amendment to deferred tax recognition under the IAS 12. That is now what we want to look at it. But let me try to check my time. This is 8. This is 8. So we can still use 30 minutes so that we can watch our football. I also enjoy football and I don't want to miss that match as well. Okay, so amendment to deferred tax recognition under IAS 12. Amendments are intended to reduce diversity in practice, requires recognition of deferred tax assets and liabilities for temporary difference in any arising from the initial recognition of lease. Then clarity is provided in times of judgment required in determining whether the temporary difference exists or not. Where will I see this? Rights of use asset and lease liability is talking about IAS what? I mean, it's talking about IFRS 16, like I said. And then the decommissioning assets and decommissioning liability is talking about IAS 16 and IAS 37. Both standards talk about this decommission. The IAS 16 is talking about capitalizing the decommissioning, while IAS 37 is talking about when it is probable for you that you are liable to this liability, you must start making the provision. And the tax people will not accept that because they are not using standard. They are using tax law. Is accountant that is using standard. So that is what will be causing the difference. And from there, we'll be having the deferred tax asset or liability. So the recognition. Taxable temporary differences. A deferred tax liability shall recognize for all taxable temporary differences, except to the extent that the deferred tax liability arises from A, the initial recognition of goodwill, the initial recognition of an asset or liability in transaction, and then it is a business combination at the time of transaction affects neither accounting profit nor taxable profit. So I don't think I need to dwell more on this. Let me move forward from here. We are still going to see more of that when we move forward. So either you are writing FR or you are writing CR, or you have even passed, you are in practice, you need to understand the deferred tax. And the deferred tax is one of the stubborn standards, okay, in accounting. So the deferred tax under IAS 12 are tax deduction for payments attributable to asset or liability. The lease asset deduction relates to the expenses, depreciation, and interest expense. So these are the things that can cause the difference under lease. Then,
hello, Mr. James.
okay, I'm with you.
Please, can you come back on your recognition?
Recognition from the one I just finished, Abby.
Yes, sir.
Okay.
Thank you.
You mean, is it here?
Yes. How to recognize it on the financial statement.
Okay, so which aspect is
for the deferred tax?
Okay, the deferred tax.
Yes.
Okay, so for deferred tax, when you calculate your deferred tax, okay, though we are still going to talk about that extensively, we still have that in the future. So the deferred tax, if it is assets or liability, you don't recognize the assets in the financial statements. You only recognize the liability. Okay, then in the subsequent year, you will now be recognizing the difference between the liability and the carrying forward from the previous year. Let's assume last year you have liability of the factors to be 20,000. And this year we have 18,000. The difference you are going to be recognizing in your P or L, in your OCI, will be 2,000. Is the difference in the movement in the tax that you'll be recognizing, not the whole thing. But initially, at start, anytime you have the tax liability, you will recognize it in the financial statement. Okay, I believe that one is clear.
Oh, yes, thank you very much.
All right. So let's move on. So let's move on to where we stop. Okay, so this is where we are. Then carrying amounts, which is equals to tax base, no temporary difference. When there's no temporary difference, then tax asset equals to new when it's new, and then when the tax base is also new. So this information you are seeing is country specific. So it depends on the tax law of each country. So what Nigeria is going to have will be different from what USA is going to have because our tax law are not the same thing. Okay, so let's move on. Then when we are talking about lease liability, we have recognition in separate, and we also have apply initial recognition. So I'm going to talk about that I hope I have enough time to talk about that. Now, only if the recognition of a lease assets and lease liability or decommissioning liability and decommissioning asset component give rise to taxable and deductible temporary difference that are not equal will be recognized. If when you calculate your lease and you calculate your decommissioning, and the figure you're having as an accounting aspect for lease is the same thing for what tax people are recognizing, there's no need for you to calculate deferred tax because the difference is zero and it will not have any effect. The same thing to decommissioning. That is, we can have that equal base if the payment is involved, because the tax people will look at the cash movement. If the payment is involved, there's possible that you, accounting, and tax people will agree on the same figure at the end of the time. Okay, but if the cash movement is not involved, definitely the tax people will not agree with you. Example of this is recognition of the tax liability, but is unable to recognize an equal and offsetting deferred tax asset. It is unable to benefit from tax deductions. I still have more on that to talk about. Then different tax rates may apply to taxable and deductible temporary differences. In such a case, an entity will need to account for the difference between the deferred tax assets and the liability in profit or loss. Let's move. I still have enough case study to discuss this standard. Now, I think I've jumped one case study. Let's go back to that case study. Okay. So from our case one scenario, if you remember our case one scenario, they said calculate deferred tax for right of use assets and lease liability on 1st of January 2023. Then 2, show the accounting entry for deferred tax on 1st of January 2023, separating the deferred tax arising from the initial direct cost and upfront lease payment. Don't forget the upfront lease payment was 20 million, what we discussed. Then the initial direct cost was 5 million naira. So they want us to calculate deferred tax on this. That is what we want to do next. So if you have questions as we move on, don't hesitate to ask or mute your mic and ask your question. Okay, so let's go to that now. So the calculation now is that when we are talking about rights of use assets, the advance lease payment of 20 million naira, that would be in the current amount of who? Of the accountant. The initial direct cost will also be in the lease. Will also be in the accounting book. But the tax people will not agree in this aspect. Why? Because this one is talking about assets. And for those who are familiar with tax preparation, you will see that they always disallow some expenses. And for example, if you purchase expenditure, capital expenditure like motor vehicle, they will add it back to the profit. If you are charging it as expenses, which has reduced your profit, but tax people, they will add it back to your profit. They will disallow it because it's not to be treated under that adjusted profit. It will be treated separately. And that will cause the difference. Because they will be disallowing it, that will cause a difference of 20,000. And because you are capitalizing this 5 million naira of commission, it will also be disallowed. And you'll be having this difference. Then the initial lease, initial measurement of lease liability will also be disallowed. Why? Because it's a provision, and provision is not allowed. So tax people will disallow all these costs, and they will now apply tax rates of how much? Of 30%. And tax rate of this 30% will give them what? We give them 30% or 20 will give us 6 million. 30% of 5 million will give us 1.5. 30% on 45 will give us 13. Okay? So the deferred tax year that we are going to be having will be 13 point what? 13.67. And is it going to be liability or asset? It's going to be what? It's going to be liability. Because they are adding back all this now, and in the future, I mean, it's going to be asset, sorry. It's going to be an asset because they are adding back all this now, and you are paying higher profits today. But in the future, you are going to be paying lesser taxes. So it's an asset for you. But if you are paying lower tax this year and you are going to be paying higher tax in the future, that is a liability. You are going to pay that liability in the future. That is the difference between the deferred tax assets and deferred tax liability. I believe I'm not having any question. Now, the second question is, how do we now recognize it? Like your question. To recognize deferred tax on initial recognition of right of use assets and liability on 1st of January. Okay, so let's continue from where we stop.
Okay.
You have question? I'm going to round up now because I want us to finish this thing before 9. Okay? I want us to finish before 9, if possible. Let's see how it goes. So this is where we are now. So we said, I hope I'm recording these things this morning, Sha.
Yes, yes.
Okay, all right. Okay, so to recognize now, we have profit or loss. How much is this figure we are talking about? This figure of 7.5. So this will be going into our, no, the first one is 6 million on the advance payment. And then the second one is 1.5 on the advance payment of commission, making the 7.5. That 7.5 will debit our expenses on the profit or loss. Then we will credit that deferred tax liability. Okay, is a deferred tax liability. Why the second one is 13.67. What do? We are going to debit deferred tax assets, and we also credit deferred tax liability. The 2 here is giving us 0 as out of today. Why? Because this thing has not occurred. So it's still going to start happening in the second year. And if you look at this one, the first one, the payment has already been made. That is why the other leg is going into the profit or loss, and the deferred tax liability is going to the credit side. But what will happen in the next year? What are you going to do? You will now be reporting the difference, the movement in the deferred tax. So if your deferred tax in the next year is going to be 20, is going to be 10, you are going to report 10 minus 7.5, so which is going to be 2.5. That is what is going to be the movement in the deferred tax. So if you check ICANN Park, you are going to be seeing, a much question on that. Don't forget, I'm not treating deferred tax extensively. I'm only talking about the amendments. If you want to take deferred tax, it's going to take us more than this normal hour. That is IAS 12. It's going to take us this more than this allotted period. So case 4, what is he saying? Case 4 is talking about the decommissioning aspect, and it calculates tax in respect of the asset and decommissioner liability on 1st of January 2023. Show the accounting entry. How do we post? How do we show it? This decommissioning and the what do we have the other one? The lease are not captured by IAS 16 before. I mean by IAS 12 before under the deferred tax. So that is the amendment we are talking about. Okay, so let's look at it now. How do we adjust for this? We are talking about the property, plant, and equipment. And the commissioning is 20 million naira in the nearest 10 years. But is that 10 million is in future cash flow, I mean future value. And we have to discount it to the present value. And it's only the present value that we recognize now. Now, we are recognizing that present value doesn't mean that it has actually occurred. It's a provision in accounting aspect. But in the tax base, provision is not allowed until you make payment for it. Okay, that is why the tax people will disallow that 7.7. And that will cause a difference of what? Of 7.7. And by the time you apply 30% rate on it, you'll be having 2.3. That 2.3 is now our deferred tax liability. Why is it deferred tax liability? Because the tax people will add back this provision this year, and you will be paying what? You will be paying the lesser, you'll be paying the higher tax. Okay, sorry. Because this one is PPE, Abi. So PPE, because you are capitalizing it, so you are not expensing it. So this PPE will not eat your profit or loss in your own normal accounting. So it does not reduce your profit. But when these people are adding back, do you understand now? When these people are adding back, it's going to reduce your profit because they're going to deduct it from your profit now. And as a result of this, you are paying lesser tax than you're supposed to pay, which means you are going to pay that tax in the nearest future. That is why it's a liability. Assuming you expense this off now, assuming this 7.7 goes into your P or L, it will reduce your profit. When tax people add it back, it will be tax, I mean, it will be deferred tax asset, which means you are paying lesser tax this year. I mean, you are paying higher tax this year. You'll be paying lesser in the future. I don't know, maybe that aspect is clear and there's no question. How do we recognize this in our book of account? We will recognize this as deferred tax asset. We debit the deferred tax asset, and then you also recognize the deferred tax liability. These two will continue to move in your accounts at the end of the year. These two will be zero. The two, both asset and liability, must be zero when you complete the payment. In the next 10 years, 2.3 of assets and 2.3 of liability must be zero when you continue to unwind the deferred tax every year. The difference will actually result to zero, and that will be the difference. Okay, I think we are almost done. What aspect do we have to do? So what is the transition requirement and the effective date of change is talking about? The amendment is applicable for annual reporting period beginning on or after 1st of January 2023. So it means if you are a tax consultant, you should have started computing deferred tax for lease and for decommissioning. If you have not been doing that, you are going against IAS 12 amendments. Okay? No retrospective application in line with IAS 8. IAS 8 will say you should go and correct it from the previous year. No, you will just start. If you have not been doing it before, you will just start from January 1st. I mean, January 1st, 2023, and you start recognizing that deferred tax. So you don't need to go back to your previous years of account and start doing it retrospectively. You will start immediately and you continue. Okay, then amendment should be applied for the first time by recognizing deferred tax for all temporary difference related to lease and decommissioning obligation at the beginning of the earliest comparative period presented January 2021 to December 31st. Then amendment to transaction that occur on or after the beginning of the earliest comparative period presented, recognize a deferred tax asset, recognize deferred tax liability, and recognize the cumulative effective of initial. Okay, I believe I think I should be rounding up now. So this is the last illustration. Okay, this is last illustration. So let's discuss this before we close for today. What is it saying? KS Limited recognized a provision for the decommissioning of nuclear plants in 2011 for 45 million naira. It capitalized the associated expenses as an asset and depreciated this over 60 years. Expected period of useful life, decommissioning is required. The tax rules allow for deduction of these expenses on a cash basis. That's what I said. Tax people are always after cash basis. There's nothing, they are not interested in provision or we are making provision for future. No, they look at the movement of cash. At the time of the transaction, KS applied the initial recognition to both the asset and liability separately. Therefore, no deferred tax has ever been accounted for in relation to this transaction. The appropriate annual discount rate for the provision was deemed to be 6%. The table below shows the associated carrying values of the provision and assets at relevant dates. So if you look at it, on 1st of January 2011, so the current amount of this asset will be 45 million naira. That is, you must have calculated your depreciation. You know, it's going to be 5 years. So the initial cost of the asset is 45. Deferred tax will be what? Deferred tax will be 9 million naira. As long as these people did not record, because the depreciation on this 45 million is what? 45 million divided by 60 years will give us 9. So it means they'll be charging 9 every year. And that 9 will be the temporary difference because the tax people will not agree with you. And that temporary difference will be the 9 million naira. Then apply your tax rate. If the tax rate is 9 million, I mean it's 20%, apply the tax rate and you get your deferred tax assets or liability as the case may be. Now, KS adopt the IAS 12 amendments in its financial statement for the year ending 31st December 2023, with the beginning of the earliest period presented being 1st of January 2012. Don't forget, the requirement accounting entry on this date of transaction is 1. You will recognize the deferred tax of 17 million, which is under the calculation there. Then deferred tax liability that you are going to apply that year will be the 7.4, and then the difference, because you cannot go back to previous year to calculate, to amend, the difference will be posted to where? To retain earnings. That is prior year adjustment. So you don't need to go back to the previous year and start correcting it year by year. No, just deferred tax asset of 17 million naira. Then the current year deferred tax is 7.4. Then the difference to balance it is 9.7. Put it on the retained earnings and you are good to go. Any question on this so that we can go and watch our match in peace? Any question, any comments, any observation, whatever you want to say? You can use your chat box. You can use your mic. So for those who are writing FR, watch out for IAS 12. For those who are writing CR, watch out for IAS 12, either of the two. Because I'm sure ICANN can test IAS 12. Though they tested it last diet, I think in FR or CR. But this one, tonight we have tested, we have explained like 3 standard now, or 4 standard cell. I touch IAS 12, I touch IAS 16, I touch IAS 7, IFRS 16, I also touch IAS 37. I have a question here. Please, can we have the slide and recording? Okay, I will try. I will try to make it available. Any other question? In the next 1 minute, I will end the meeting if there's no question. It means it is very clear to every one of us. I think I have another question. Thank you, sir. Okay, you are welcome.
I'm just appreciating you. Though I
All
will
right.
still chat you privately, Sha, because I have a concern with that exchange game.
Okay.
So I will still chat you.
Okay, no problem.
Thank you.
All right. Thank you for your time. Thank you, sir, for your time. You're welcome, ma. I believe it's very clear. For those who are in practice, it's clear. For those who are writing, ICANN is also clear. Both of us need it. Thank you, sir. You're welcome, sir. Okay, so let's go and watch our match. Up Nigeria. Let's pray for Nigeria so that we can get our hope. I think I still get question. Okay, thank you, sir. You're welcome. You are welcome. So I will stop sharing and then I will end the meeting.